What's going on, everybody? Welcome back to the channel. I appreciate you stopping by, spending a few minutes of your time here with me today. We are back with the extended version of our trapped volume video. Okay, I've got some custom made slides that you can screenshot and save for easy access. We're also going to go over some chart examples, all right? So you can actually see this and get used to seeing it so you can identify it in real time in your session when you are trading, all right? So let's get straight into this video, all right? Trapped volume, all right? Now, what makes a setup a 90-10 setup? Simply put, a 90-10 setup is a setup that's being driven by higher time frame traders. Once we have higher time frame traders triggered and trapped on the wrong side of the market, there's a very high probability that it will not come back to where those traders have been trapped, because if it did, that would be letting those traders out of their trades at break even or with just a small loss or win, okay? Now, the market doesn't politely ask if it can have some of your money, right? It just drains your account. There's no mercy in this game. Trading is a zero-sum game, right? For every winner, there's a loser. It's a dog-eat-dog world out there, and the goal of the market is to take money from the many and put it into the accounts of the few, okay? And the few, that's what we're calling smart money, all right? There's so many retail traders out there in the world, and we know the statistics, right? Prop firms give out these statistics and say that 90% of traders will lose 90% of their capital within the first 90 days, all right? So most retail traders are simply supplying liquidity for winning traders, okay? So how do we identify when we have higher time frame traders in the market? Well, higher time frame traders are triggered into the market at the breaks of monthly, weekly, and daily levels. But for the sake of this video, we're going to be focusing primarily on daily time frame traders, okay? So daily time frame traders, when we say that, we mean traders that are using the daily charts as their entry time frame, okay? The daily candles, that's the lowest these traders are going. All right, and they're waiting for us to break the high or the low of the daily candles, okay? So you can see down here in this drawing, these are supposed to be daily candles, right? And daily time frame breakout traders are triggered at the breaks of daily candles. So once this day breaks the previous day's high, breakout traders have pending orders sitting there. They are convinced that because we've broken out of the previous day's high, that we're going to continue to see higher prices. And sometimes they're right, but we know that 80% of breakouts fail, right? Now, if daily time frame traders are entering at the breaks of daily candles, they will most likely be placing their stops at the opposite side of the daily range, right? So if the new day opens and breaks this day's high, they're getting in right there, and they're going to put their stop loss on the opposite side of that range, okay? It's either going to be at the low of the current day, of the new day, or the low of the previous day, all right? And because of this is why we see these parabolic setups that go up, trigger higher time frame traders into the market, trap them on the wrong side, and then go parabolic straight from the high of the day to the low of the day to take out those stops, all right, and liquidate those traders. Now, once those daily time frame traders are triggered into the market and trapped buying high into the high of the day or week, the market will often reverse and go straight to the opposite side of the daily range to hit their stops and liquidate their accounts. So how do we know when we have traders trapped on the wrong side of the move? We're looking for certain chart patterns, certain candlestick patterns that literally show us when traders are being trapped, okay? They're the same patterns we went over in the peak formations video, okay? Basic reversal patterns and engulfments, all right? So I drew this simple example here, right? Here's our previous day's high, the blue line, okay? And you can see we break out, we start chopping sideways, and each one of these pushes up here into the high is getting more and more traders buying into this market, okay? And then suddenly over here, boom, we engulf. We engulf that entire consolidation up here, all right? When that happens, that engulfment is exactly what traps those traders, okay? Because they're entering the market up here. They're buying, right? Their entries are engulfed and they are effectively trapped. They're taken into immediate drawdown, and the market is not going to come up there and let them get out of that trade, okay? It's going to take them for a loss. It's trying to cause basically the most pain possible, right? So the smart money strategy is buy low and sell high, okay? Now, we already said it, trading is a zero-sum game. That doesn't only mean that for every winner there must be a loser. It also means that for every buyer there must be a seller, and for every seller there must be a buyer, right? So if smart money is trying to offload a bulk position, they need to sell a very large position. What that means is that they need buyers who are willing to take the opposite side of their trade. So if smart money is trying to sell high, they need traders who are willing to buy high, okay? So smart money needs someone to take the opposite side of their trade, all right? They can find these willing traders at the levels, all right, aka the previous day's high, in the form of pending breakout orders and stop loss orders that are resting at that level, all right? Now, something that often confuses traders, right, is that they think that the market is somehow controlled by a single entity, right? Or that smart money or the market makers or whatever, they're controlling where price goes, but they don't have to do that, all right? Smart money is not buying the market to push it up to the high and then sell it, okay? They're not doing that. They may sort of on a sly sort of be buying small positions on the way up, just building up their inventory, all right? But due to natural mechanics of the auction, all right, price is naturally drawn to levels where there is high liquidity resting, okay? So all they have to do is sit back, be patient, and wait for their edge to play out in the market, okay? Smart money are traders who are patient enough to sit back and wait for their edge to present, and then they have the understanding and the capability to execute on that. So all they have to do is sit on their hands and let the market naturally trade back to this level, all right? Once it hits that level, all of these higher time frame traders are triggered into the market, okay? They're buying the market. There may be stop loss orders sitting here from traders who were selling from that level before, all right? Once all of those buy orders are triggered in, that gives the smart money everything that they need. There's the liquidity they need to offload that bulk position. So all they do, wait for that level to be triggered, and then they sell aggressively into that level, which results in a dramatic drop in price, okay? Does that make sense? I hope it does. If any of these slides or if anything I'm saying gives you questions, if it confuses you, just reach out in the comment section. I'll be glad to clear it up for you, or get with me in the Discord server and we can iron out all of the details, right? So let's go over some of these charts. Here we're looking at the DJ30, okay? Now, you can see here that the previous day, we've broken the day before's low, all right? This red line is the previous day's low. Up here is the previous day's high. So you can see we've broken out of that low, okay? That means we have higher time frame traders triggered into this market. But as you can see, sellers remain in control and this market continues, right? So we break out, pull back, and then continue to auction lower. This day closes in breakout, okay? We close below the low of the previous day. So we close in breakout, okay? That's a signal for us, okay? That means that the next day we're looking for possible trade opportunities, okay? So here in this Tokyo session, we have our initial breakout, Okay, we have the initial break of the previous day's low. That triggers higher time frame sellers into the market, all right? And as we continue to go lower, more and more traders are hopping in this market and selling it, okay? And you can see here, we have a clear head and shoulders pattern, an inverse head and shoulders pattern, just like we went over in our peak formations video, all right? Here in the London session, all right? So all of these traders who are selling here unknowingly are selling into the low of the day and the low of the week area. Here the market reverses and goes parabolic straight from the low of the day to the high of the day, where those higher time frame traders have their stop loss orders resting, okay? Boom. Very clean trade. This is where you will get your highest probability, the 90-10 type of setups, okay? The ACBs ain't coming back. This is where you have your sizable opportunities and asymmetrical risk to reward, okay? And then the very next day, or that same day rather, right? This is the same day where we reversed and went higher on the DJ30. We break the opposite side of that daily range, continue to auction higher, and then close in breakout, okay? Now, since we've broken out of the high of the previous day, daily time frame traders will have a strong conviction that the market will continue to make higher prices, okay? And you can see as that new day opens, we're just coiling sideways up there at that level, the high of the week, high of the day type of level, all right? And you can see we've sort of broken out early in the Tokyo session, but there's really no evidence of trap traders. We want to see clear reversal patterns at the high or the low of the day to identify these trap traders, okay? So here you can see we've broken that high of the day, headed closer into the New York session, right? But we still don't have any evidence of traders being trapped here, all right? We don't have any aggressive moves to the downside that's engulfing and trapping all of those buyers up there at the high of the day. But just a little bit later, we do, all right? We go down low, take out the low of the day, reverse, go back, take out the current high of the day, all right? And once we take that level out, we put in this very clean double top, this M pattern at the high of the day. Now, this is a 1 minute chart. So this M pattern on a 1 minute chart is an engulfing 5 minute candle, all right? The trap is set as we break out of the previous day's high. That's the trap being set. All right? But the trap is not sprung until we see this engulfment, this aggressive move to the other side, locking those buyers into a losing position. All right? And here we're looking at the Euro USD, okay? The same day, basically the same setup. We have our close and breakout signal the previous day, all right? And then here, we break out of that previous day's high and put in 1, 2, 3 pushes into the high. When we have multiple pushes into that high of the day level, right, this continues to convince more and more traders to buy into this market, even though they are buying into the high of the day or the high of the week or whatever, right? This is what we might call inducement. These traders are being manipulated into buying something that they shouldn't, okay? And then they are taken for a loss. Here we're looking at a 1 hour chart, okay? And you can see this large engulfing candle on this hourly chart. It engulfs everyone who was buying up here into the high of the day. Their entries are right here. Boom. When that move happens, that first 1 hour engulfment, all right? And I'm just using the 1 hour so it's easier for you to see the trap, okay? All of their entries are engulfed, which means they are immediately thrown into drawdown. They are locked into a losing trade, okay? And we know traders don't want to close that down. They might even be averaging into a loser here, okay? They're going to hold on to that thing because they saw the breakout. They think we're just going to pull back and then continue to go higher. But instead, we go from high of the day straight down to the low of the day, hitting those stop losses, collecting that liquidity. Right? And here again, we're looking at the Australian dollar, US dollar. Again, we have broken out of the previous day's high with this large spike. Boom. That right there gets traders excited, bro. And they are buying into this market. All right. But as soon as we reverse and we break that death line area, okay, we engulf all of those entries here going into the high of the day, immediately in drawdown, and price continues to fall all the way to the close of the day. All right. And again, the Australian dollar, US dollar, you can see this was a really good example. We broke out of the previous day's high a couple times in the Tokyo session and then continued to go lower. All right. This market then auctions back up there, snatches that liquidity there, triggers those higher time frame buy orders that are resting above those equal highs, and then immediately engulfs. Okay. Engulfing all of these entries from here and then drops straight from high of day to low of day levels. And then this is just a bonus little slide right here, okay? Because, and believe it or not, these are also high probability trades, but they may not be the 90-10 opportunities that we're looking for. In other words, these are might come back type of trades, all right? They might come back against you. So you can see, right, we have still a very nice box in play, this high, this low. Price opens, okay, because look, what we're looking at here is multiple days of lower closes, all right? So we see that all the time. We will see consecutive days that close green or consecutive days that close red. So just based on the logic of how price moves, right? And if you're taking the basic market fundamentals like wicks on candles, right? Those wicks are very important to me, right? Because I know, okay, let's say this day gave me a lower close. So the next day I'm expecting a lower close. What I would want to see happen is price trade above the closing price and then reverse in a session to go ahead and continue putting in lower prices, all right? Same thing here. Price gives us a red close, a lower close than the open, and then the next day we open, we trade above the open, and then collapse, giving the next lower close. Now you can see here, all right, we're not triggering daily time frame traders into this market, but we are trading or triggering 4-hour time frame traders into this market, okay? And what that means is instead of like how daily time frame traders are triggered in at the breaks of daily levels, 4-hour time frame traders are triggered in at the breaks of session levels. All right. So the same way here, we've got a Tokyo London high right here. As soon as we break that level, okay, 4-hour time frame traders are triggered into that market and they are buying this thing up. Okay. And you can see over here, we've broken this little swing high in the previous day's New York session. Okay, there's liquidity resting above equal highs and equal lows to the left. All right, so this market comes down, snatches this liquidity, pumps up, snatches all of this liquidity, and then reverses and traps traders at the high of the day. So we're still seeing traders trapped at the high of the day. The market goes parabolic from high of day to low of day, but we haven't broken a daily level, right? We have broken internal levels, session levels, okay, which is triggering in 4H traders into the market. And you can see the basic stair-step pattern, okay? We're in a downtrend, so these swing highs should stay in place. So you see we're just going up, retesting the previous day's levels before failing and continuing the higher time frame downtrend, right? So this is just a bonus slide. I look for these types of trades often, right? Especially when we have something like this where there's a peak formation low put in at the or near the close of the day, and then we start pumping up. Immediately that becomes a target for me, okay? And I would be looking for something like this. But this is an example of a might come back type of trade, right? We do not have daily time frame traders triggered into this market, so we may not be able to call this a 90-10 or an ACB trade, but you can still have pretty high probability trades. But you still have to make sure that we have higher time frames trapped in the market, whether that's monthly, weekly, daily, or 4-hour time frame traders. All right, so that's going to do it for this video. Let me know if you're confused about anything or you've got questions, just let me know. But anyway, until next time, I hope you continue to free your mind.